Hello and welcome. Today we are going to dive into a simple moving average strategy that is not just easy to understand, but also a great way to improve your trading decisions. By the time we are done, you will know exactly how to use this strategy to spot trends and make more confident trading choices. So stick around because this could really help you step up your game. Before we dive into the specifics of the strategy, let us first understand what makes a simple moving average such a powerful tool for traders. Imagine trying to follow the path of a tiny boat on a stormy sea. Each wave, each dip, makes it nearly impossible to predict where that boat is headed. A simple moving average helps to calm those waters, giving you a clearer idea of where things are going by averaging out the ups and downs. By taking the average price of an asset over a period of time, whether it is 10, 20, or 50 days, you get a much smoother path to follow. This makes spotting trends so much easier and helps filter out all the noise of daily price changes. With the simple moving average, you get a reliable way to see where the market is actually heading. So why does this matter for you? The simple moving average can help you figure out the overall direction of the market. Is the market going up? Is it going down? A simple moving average helps answer those questions by giving you a clear picture of the market's trend. When you use a simple moving average, you start to notice patterns that can be extremely useful for making decisions. One of the most common patterns you will see is when the price stays above the moving average for a long period. This often indicates an uptrend, meaning the price is likely moving in a positive direction and buyers are in control. Think of it as driving along a smooth, uphill road where things are consistently moving upwards. This is generally a good sign that the market is healthy, and it could be a good time to consider buying. On the other hand, if the price stays below the moving average for a prolonged period, it indicates a downtrend. This is like driving on a downhill road where prices are falling and sellers are in control. When you see the price consistently below the moving average, it may be a good idea to hold off on buying or even consider selling if you already hold a position. Another interesting pattern involves how the price interacts with the moving average line. If the price touches the moving average and then bounces back up, it can signal a continuation of the uptrend. This bounce often shows that the moving average is acting like a support line, where buyers come in to push the price higher. Conversely, if the price hits the moving average and falls back down, it could mean the line is acting as resistance, and the market may continue to fall. Sometimes the price may cross above or below the moving average line. When the price crosses above the moving average from below, it often signals the beginning of an uptrend. This is a sign that buyers are becoming stronger and momentum is shifting upward. When the price crosses below the moving average from above, it could indicate the beginning of a downtrend, suggesting that sellers are taking control and prices may keep falling. Recognizing these different patterns is key to making informed trading decisions. It is about understanding the story that the price and the moving average are telling. Are we moving up, moving down, or just bouncing around? When you know the general direction, it becomes much easier to figure out when it might be smart to buy and when it might be best to sell. The moving average acts like a guide, cutting through the confusion of daily price changes and helping you see what is really happening. That is the true power of the simple moving average and why it is such a valuable tool for traders of all levels. Now let us get into how you can set up this strategy. We are going to use two different simple moving averages. One is for the short-term trend, and the other is for the long-term trend. A very common setup is to use a 50-day simple moving average and a 200-day simple moving average. The 50-day average will help you see the short-term movements, and the 200-day average will help you understand the big picture. You might be wondering why use two different moving averages. Here is why. When you use a short-term and a long-term average together, you can see when the trend might be changing. For example, when the short-term moving average crosses above the long-term moving average, that usually means the market is starting to go up. When it crosses below, it means the market might be starting to go down. This crossover gives you a signal about when it could be a good time to buy or when it might be smart to sell. Setting up these moving averages is not hard at all. Most charting platforms will let you add a 50-day moving average and a 200-day moving average without much trouble. Once you add them to your chart, you will start to see how they interact with the price of the asset you are looking at. It will start to make sense why these averages are useful. As the lines move, they form patterns that help you interpret what is happening with the price. For instance, when the price of the asset is consistently above both the 50-day and 200-day moving averages, it suggests that the asset is in an uptrend and the market sentiment is positive. You can think of it as a sign that confidence is high and buyers are in control. When the price dips below these moving averages, it can indicate a potential weakening of the trend or even a reversal. This is a cue for you to be cautious and consider if it is time to take action. The point where the 50-day moving average crosses above the 200-day moving average forms what we call the golden cross, a signal that things are likely shifting to a positive trend. This pattern often attracts a lot of attention because it is a sign that buyers are gaining strength. On the other hand, if the 50-day moving average crosses below the 200-day moving average, it forms the death cross, signaling a possible downtrend where sellers might be taking control. These visual cues on the chart make it easier to understand what might be happening in the market, allowing you to make better decisions. Imagine these moving averages as roads guiding you through a city. When the roads cross in a particular way, they tell you whether you should continue on your path or take a turn. By following the movements of these lines and understanding the patterns they create, you gain a clearer sense of direction in your trading decisions. Now, let us talk about how to use these moving averages to find buy and sell signals. The first thing to know is something called the golden cross. When the short-term moving average, which is the 50-day in our example, crosses above the long-term moving average, the 200-day, that is called a golden cross. This is usually seen as a strong sign that the market is going from a downtrend to an uptrend. It is like a green light telling you that the market is gaining strength and it might be a good time to buy. On the other hand, there is also something called the death cross. The death cross happens when the short-term moving average, like the 50-day, crosses below the long-term moving average, such as the 200-day average. This pattern is a strong indication that the market may be losing momentum and entering a downtrend. When the short-term average dips below the long-term one, it suggests that recent price action is weaker compared to the longer-term trend, which can be a red flag for traders. The death cross is often seen as a sign that selling pressure is building and that the market could continue to decline. It signals that it could be a good time to either sell existing positions or avoid making new purchases until conditions improve. Traders see this pattern as a cautionary sign that things might get worse before they get better, and it is a cue to exercise more caution moving forward. Let us take a practical example. Imagine you are looking at a stock chart and you see the 50-day simple moving average slowly rising and eventually crossing above the 200-day simple moving average. This moment is called the golden cross, and it is often seen as a positive shift in the market. You can think of this as a turning point where the stock that was previously struggling might start gaining momentum. It is like seeing the clouds part and the sun come out, signaling better days ahead. The golden cross suggests that the market sentiment is changing for the better, and buyers are gaining more control over the price. Many traders see this as a buying opportunity because it indicates that the stock might be shifting from a period of decline to a new uptrend. Imagine pushing a heavy boulder up a hill. At first, it is tough and slow, but once you get to the top and start going downhill, things get easier and the boulder starts moving on its own. This is similar to what happens during a golden cross. The hard part, the decline, is over, and momentum starts to build in a positive direction. This pattern is particularly powerful because it combines both short-term and long-term perspectives. When the shorter-term moving average 50-day crosses above the longer-term moving average 200-day, it shows that recent price performance is starting to outpace the longer-term average. This means that the market could be gaining strength and there may be more room for growth. It gives traders a sense of confidence that the uptrend might be sustainable, and it is often used to time an entry into the market for the best possible outcome. Now, it also works in the opposite way. If the 50-day moving average starts to fall and crosses below the 200-day simple moving average, that is what we call the death cross. It is a signal that the stock might be losing its momentum, and things could be starting to turn downwards. This pattern tells you that the market could be entering a downtrend, which means it might be a good time to exit your position or avoid buying more until things look better. These patterns are like a story being told on the chart. When you see the golden cross, it is the beginning of a possible positive chapter for the stock. When you see the death cross, it might be the start of a challenging period where caution is needed. Recognizing these changes can help you make smarter decisions about when to enter or exit a trade. So how do you use these signals to decide when to enter and exit a trade? For entering a trade, you want to look for that golden cross. The point where the short-term moving average crosses above the long-term moving average is your signal that buying pressure is building. This tells you that it could be a good time to buy. For exiting a trade, you want to watch for the death cross. When the short-term moving average crosses below the long-term moving average, that means the trend might be reversing. This could be the time to sell your position or reduce it to avoid potential losses. Another thing to consider is setting up stop losses to protect yourself. One way to do this is to place a stop loss just below the long-term moving average. That way, if the price suddenly moves against you, your losses will be limited. It is a good way to protect your money if the market does something unexpected. Now, while the simple moving average strategy works well on its own, you can make it even better by adding other tools. One great tool to use is the Relative Strength Index, often called the RSI. The RSI measures the speed of buying or selling, giving you an idea if people might be getting too excited or too scared. When an asset is overbought, it often means people have been buying a lot and the price may have gone up too much too quickly. On the other hand, if an asset is oversold, it means people have been selling a lot and it might be priced lower than it should be. Think of it like trying to figure out if something is a good deal or overpriced in a store. If the price has been driven too high, it might not be the right time to buy. If it is priced very low, it could be a bargain. The RSI helps you see these situations in the market. When you use it together with the moving averages, it gives you more confidence in your decisions, especially when both are pointing in the same direction. For example, if the moving averages are showing an uptrend and the RSI indicates the asset is oversold, it could be the perfect time to enter the market. It is like getting a double confirmation that the conditions are in your favor. If you see a golden cross forming and at the same time the RSI shows that the asset is oversold, which means the RSI value is below 30, this makes your buy signal even stronger. An oversold RSI tells you that people may have been selling too much, and it could mean the price is lower than it should be. This could be the perfect time to buy, as the price might be ready to move up again. It is like when a popular item goes on sale at a store, and you know it will not stay at that low price for long. The combination of the golden cross and a low RSI tells you that you might be getting in at a great time, just as momentum starts to swing back up. Another tool you can use is the moving average convergence divergence, or MACD. If the MACD is also showing bullish momentum when you see a golden cross, then that is extra confirmation that things are moving in your favor. Combining these indicators makes it easier to make a good decision. Also, do not forget to keep an eye on the trading volume. When you see a crossover happen, the volume can tell you how strong the move is. If there is high volume when the golden cross happens, it means a lot of traders are participating, which makes the signal stronger. If the volume is low, the signal might not be as reliable. You can also adjust this strategy to fit different trading styles. If you are a day trader, you will probably want to use shorter time frames. Instead of the 50-day and 200-day simple moving averages, you might use a 10-day and a 20-day average. This helps you catch moves that happen over a shorter period, which is important if you want to make quick trades. If you are more of a swing trader and you hold trades for a few days or even a few weeks, you might want to use a 20-day and a 50-day simple moving average. This combination allows you to catch medium-term trends without getting too caught up in every little price change. And if you are a long-term investor, then the classic 50-day and 200-day setup is usually the way to go. This helps you see major trends and make decisions based on where the market is heading over a longer period. Let us take a moment to talk about some common mistakes that traders make when using this strategy. One big mistake is not waiting for confirmation. Some people see the moving averages getting close to crossing and they jump in too soon. Always wait for the crossover to actually happen and look for other indicators to confirm it before making a move. Another mistake is relying on the simple moving average alone. Remember that the simple moving average is a lagging indicator. It means that it tells you what has already happened. To make better decisions, you should use other tools like the RSI or MACD along with the moving average. This gives you a more complete picture of what is going on. And here is another thing to watch out for. Be careful not to overtrade just because you see small crossovers. These small crossovers can sometimes be misleading, especially if you are looking at shorter time frames like a 10-day or 20-day moving average. These tiny moves might just be noise, reflecting normal price swings that do not indicate any real change in trend. It is like seeing a ripple in a pond and mistaking it for a wave. You want to wait for solid, clear crossovers that are backed by other indicators to give you more confidence. Always look for strong signals that are confirmed by tools like RSI or MACD, and remember that the volume should also support the move. When all of these factors line up, that is when you have a stronger and more reliable signal. Patience is key here, as the best trades often come from waiting for the right opportunity rather than acting on every small movement. If you are thinking about trying out this strategy, it is a great idea to practice on a demo account first. This lets you use the strategy without risking any real money. You can see how the simple moving averages work in real time and get a feel for how the crossovers play out. While you practice, keep a journal of your trades. Write down what you see with the moving averages when you entered the trade and what happened after. This will help you learn and improve. You will start to see patterns in what works and what does not. Do not be afraid to experiment a little bit too. Try using different moving average timeframes to see which ones work best for you. You might find that some combinations are better suited for the specific markets you are trading or for the style that you like best. All right, let us quickly recap the key points. The simple moving average strategy relies on two moving averages, one for the short term and one for the long term, to identify important buying and selling moments. The short-term moving average helps capture the recent price movements, while the long-term moving average shows the overall trend over a broader time frame. When these two moving averages cross, it forms recognizable chart patterns that give you clues about what to do next. The golden cross is your signal to consider buying. This happens when the short-term moving average crosses above the long-term moving average, indicating that momentum is building in a positive direction. It is like a green light telling you that the market might be shifting into an upward trend, and many traders see this as a buying opportunity. On the other hand, the death cross is your signal to consider selling. It occurs when the short-term moving average crosses below the long-term moving average. This pattern suggests that the market is losing steam and might be heading into a downtrend. It is a cue that it could be time to exit your positions to protect your gains or avoid further losses. In addition to these cross patterns, it helps to look for other visual clues on the chart. For example, if the moving averages are sloping upward and the price is consistently above both lines, it suggests a strong uptrend. On the flip side, if the moving averages are sloping downward and the price is staying below them, it indicates a downtrend. The relationship between the moving averages and the price can help you understand the overall market direction and whether the trend is strengthening or weakening. You can make this strategy even stronger by combining it with other tools like the Relative Strength Index RSI, Moving Average Convergence Divergence MACD, and Trading Volume. These additional tools help confirm what you are seeing on the chart. If the RSI is low at the time of a golden cross, it suggests that the asset may be oversold and ready to rise, giving you extra confidence in your buying decision. Similarly, if the MACD is showing bullish momentum, it means there is strong upward movement that supports the golden cross signal. High trading volume during these crossovers also strengthens the signals, as it means that many traders are participating and supporting the movement. Be patient, always wait for confirmation, and make sure you practice in a demo account before you start using real money. The simple moving average strategy can be powerful if you use it the right way, but like any strategy, it takes practice. With enough practice and patience, you will be able to spot trends more easily and make more confident trading decisions. Keep working at it, and over time, you will see how much this strategy can improve your trading results. Remember to stay engaged and keep asking yourself questions as you learn. This journey is all about improving step by step, and I am excited for you to give it a try.